Without further ado, I would like to introduce Brian Wallace and Lou Young, both of whom are with Witham, who is the accounting firm that represents CADA, and also one of our preferred providers for accounting services for all of the dealerships. Um, and I'm sorry, Lou, are you kicking off?
Yes, I'll take it from here, Matt. Thanks. Good afternoon, everyone. As Matt said, we're going to cover the One Big Beautiful Bill Act. It's an interesting name. As we go through, if you have any questions, you can raise your hand, or we can wait until the end and you can ask questions. We're going to cover the business taxes and personal income taxes today. And it's been interesting. The one thing that we've been noting is that there were a few things that didn't change, and we just wanted to mention them briefly. You may have heard that there were limitations on pass-through entity taxes. That didn't occur. There's no limit on C Corp's ability to deduct state and local taxes. We didn't see any higher rates for incomes over $1 million or 2.5 million. No change in corporate or capital gains tax rates. The big one, there's no changes to LIFO. Good news, bad news. And the last thing I wanted to mention was that there's no extension on statute of limitations for the employee retention credits, affectionately known as the ERCs, for 2020 and the first 2 quarters of 2021. There was an extension for the last 2 quarters of 2021. We'll talk about that a little bit. So with that, why don't we get into the tax provisions, the business tax provisions. Brian, why don't you take the first few?
Great. Thanks, Lou. Hopefully everybody can hear me okay. Again, thanks, Matt, and the rest of the team at Colorado Auto Dealers for having us and give us an opportunity to present some of this stuff to you guys. Not super exciting, but I think a lot of this stuff is important to dealers, just to understand how this is going to impact your tax situation going forward. So I also want to say, if you're not comfortable asking a question out loud on Zoom, if you want to type it in the chat, you can type it in the chat, and we'll also respond to those questions. All right, so interest expense limitations. Hopefully everybody's kind of aware of what this is. This is, the way we're sort of presenting a lot of these is we're going to talk about what the rules were under the Tax Cuts and Jobs Act that was passed back in 2017, became effective in 2018. And then we'll talk about what this One Big Beautiful Bill Act did to either extend those provisions or change them. So if you recall, we had this Section 163J that came out with the Tax Cuts and Jobs Act, and it introduced this concept of a limitation on a business's ability to deduct business interest. NADA went through a lot of lobbying efforts to get floor plan interest scoped out. And so that was a big win back at that time. But so the way this calculation works is basically just takes 30% of this adjusted taxable income, which originally was basically EBITDA. So you got to take your taxable income, add back interest expense, add back depreciation and amortization, and that was, take 30% of that number. That was your limit. In 2022, this was all kind of built into the bill. That adjusted taxable income calculation changed, and you no longer had the ability to add back depreciation and amortization. So what happened is you'd have these years where you have a big depreciation deduction, and all of a sudden you're faced with a interest expense limitation. And so we were seeing this a lot, especially with rising interest rates. And so this was one of the things probably tops on the priority list for NADA. And what they basically did was they got it reinstated at EBITDA. So now we're back to, we can add back depreciation and amortization. So we're going to, see a lot less limitations on interest deductions. It's a win for dealers. A couple other minor things that changed in here. There was this potential loophole. I'll talk about it briefly. Most firms didn't endorse it, but there were some firms that were endorsing this concept of capitalizing interest under Section 266. It's sort of an optional election that would theoretically allow you to capitalize all your floor plan interest into your inventory and then expense it as a cost of sales. So basically avoiding the interest deduction limitations altogether. Most firms didn't endorse it, but there were people that believed that this was a viable option to get around the interest expense limitations. They closed the loophole on that. They basically said you measure interest before you capitalize anything. So you take all your interest, test it, and then you go through whether or not you want to capitalize it or not. The other thing is it expanded the definition of floor plan financing interest. So those that have dealerships for towable trailers and campers kind of help them out a little bit. So RV dealers can now also claim the floor plan interest exception and fully deduct their interest. Lou, any comments on that? You want to pop over to the next?
Yeah, I hope it's not too much. We're getting into the weeds a little bit here, but that's good.
Cool. All right, the next thing, and the next couple slides kind of go together. Bonus depreciation, Section 179. We all hopefully know about bonus depreciation. When it was first introduced, Tax Cuts and Jobs Act brought it up to 100%. So bonus depreciation has been around for years, probably 20 years in some way, shape, or form. It was 30%, it was 50%. Tax Cuts and Jobs Act brought it up to 100%. But then it also introduced this phase out. And so you're going to see there's kind of a common theme here in that Tax Cuts and Jobs Act, because of the way it was passed by going through the budget reconciliation process, it essentially, when they scored it, had to be like when they measured the impact of it over a 10-year period, it had to be basically deficit neutral. So not increase the deficit based on all the tax revenues and tax savings and all that stuff. So a lot of the provisions in there either contain phase outs or expired at the end of this year. So so when we were looking at, we had 60% last year for 2024. It was going down to 40% for 2025, and then keep going down 20% until after 2027 it's zero. And so this one big beautiful bill, it brought that back at 100%, made it permanent. So any property acquired after January 19th is eligible for 100%. This is kind of a weird thing. They actually give you the option to only use 40% for assets placed in service in 2025. So the one in the first 2 weeks of the year, you have to take 40%. You actually aren't eligible to take 100%. For the rest of the year, you can do 100%, you can do 40%. And I guess, maybe there was some tax planning that was done and might cause somebody to only want to take a 40% bonus depreciation deduction. But I haven't been able to come up with a scenario where I would want less depreciation, especially now that we can add it back for purposes of 163J. The next, you can skip to the next slide, Lou. That next comment isn't super relevant. 179. So I mentioned this in being basically the same as bonus depreciation. And the only real distinction here, well, there's a couple minor distinctions, but the major distinction is that bonus depreciation can push you into a loss for federal tax purposes. Section 179 is limited to, it can't push you into a loss. So it's limited to your taxable income. Originally, it was, I think it was $1 million, then it was adjusted for inflation. So we're at $1.25 million for 2025. One big beautiful bill that increased it to 2.5 million. It also increased the threshold where it starts to phase out. That's the other thing with 179 and bonus. Bonus, there are no phase out thresholds. With Section 179, under the new rules, once you hit $4 million, your Section 179 deduction gets $4 million of assets placed in service. It starts phasing out dollar for dollar. So if you have $6.5 million of assets placed in service, you can take zero Section 179. And again, this is effective now, 2025. Is this also me? This is also me. So those are the major business tax provisions. There's some other minor ones, and we may cover those just kind of on a higher level, but those are the ones that we thought were the most relevant. So we got into a little bit of detail on it. The next couple individual tax provisions, I'm going to get into some detail on as well. A lot of people
These
might
really
say,
fall on both sides, though. This is falling on the business and the personal.
yeah, and that's kind of why we stuck it here. Plus, when I mention things that were priorities on NADA's lists for what they felt dealers really wanted, this was up there too. So it was 163J, it was the bonus depreciation. This was probably number one on the list. All right. So basically, the Tax Cuts and Jobs Act changed the way income from flow-through entities was taxed. Historically, it would flow out and would be taxed at ordinary rates. And that was really it. And the rates were higher. So when the Tax Cuts and Jobs Act was introduced, it reduced the maximum federal rate from 39.6% down to 37%. It also changed some of the brackets and stuff in between there. So overall reduced federal income taxes to individuals. And then it also introduced this concept of Section 19 of a QBI deduction under Section 199A. So the QBI deduction basically provides for a 20% deduction on your business income. So if you have $1 million of business income, you get a $200,000 deduction. Now you're being taxed on $800,000, and it basically converts that 37% rate to an effective rate of 29.6. And that 29.6 it's meaningful when you take it, compare it to the changes that were made to C Corps. So a permanent change under the Tax Cuts and Jobs Act was to reduce the C Corp rate to 21%. And so the folks that were writing these rules recognize that all of a sudden they're putting small businesses in a worse position than C Corp owners, than big businesses. Big businesses were getting this benefit of a 21% rate. Individuals were being taxed on, at nearly 40% on the income that they were receiving through their flow-through entities, small businesses, right? And so by reducing it through the lower tax rates and the QBI deduction, it gets it closer. And then when you factor in that a C Corp, there's that double level of taxation, right? You have the 21% tax at the entity level, and then to get the cash out, you have to pay tax on it's called the qualified dividend. So it's another 20%. So you're back up to, you're definitely in a better position being a flow-through entity instead of being a C corporation. So S Corps partnerships, that's really the way to go. And so under the Tax Cuts and Jobs Act, this QBI deduction was scheduled to expire after this year. And so that was why it was tops on the priority list. Like the QBI deduction was going away and tax rates were going up to 39.6 if nothing happened. And so let's just pop to the next slide. It's a short one. The short of it is what we needed to happen happened. They permanently extended Section 199A so that QBI 20% QBI deduction is there and it's permanent, at least until they change the tax laws again. And we've got these lower individual income tax rates, so they extended those as well on a permanent basis. So next tab just shows a quick example of what it looks like for 2025. Again, they all show it's 2025, it's 2026 if this OBBA bill was not passed and they didn't fix it, and what it is under the current law. So you can see everything's the same except the QBI deduction and the tax rate, $100,000 more in taxes if they didn't do this fix. So it's 10% hit on your taxes. So it's a big win. Definitely something that is going to benefit dealers going forward. What's our next topic, Lou?
We've got folks joining us a little late, but the next topic is the SALT deduction. I can go through this if you want. Individuals limited under the old provision, which was the Jobs Act, individuals were limited to $10,000 deduction for state income and local taxes, property taxes for the most part. And this was expiring at the end of this year. We got a little bit of a surprise. The SALT limit was increased to $40,000, 20 for single, 40 for married filing jointly. It's indexed for inflation, and it's scheduled to expire at the end of 2030 when that limit reverts back to 10,000. So hopefully there'll be some act of Congress to come in and make that permanent as well. But for a few years, we do have that higher limitation. This is going to be a common theme today. There's phase out provisions for taxpayers over certain adjusted gross income levels. In this case, anybody over 500,000, the limitation phases out. It's reduced by 30% of the excess of MAGI over the threshold amount, but not below $10,000. So over the adjusted gross income, it gets reduced by that 30% based on your income, but it never falls below the old level.
So this is like a middle class tax break, right, Lou?
Sure, it's a middle tax.
Individuals, they don't see a benefit from this, right?
Right. And keep in mind, I don't know that we mentioned it in here, but the standard deduction for married filing jointly was raised to $30,000. So, this is great. You add this to some other deductions that you can take advantage of, and you might get over the $30,000. A lot of folks will, but that's a pretty hefty standard deduction, which, if you've got higher state taxes, it's great. You're able to take advantage of that. But for the most part, the high standard deduction is pretty good. And that was raised as well.
And Lou, if I can step in for just a minute. Guys, you may or may not have heard that Colorado is calling a special session of the state legislature to fix a $2 billion economic gap. And one of the ways that they are looking at doing that is by reclawing all of the excess state deduction. So what the feds are giving back, they may attempt to take again at the state level, but they will come back into section. Our best information is August 20th. So stay tuned to us over the next month or so to see what's being introduced and what's being passed.
Yeah, Matt said it best at the beginning of the session. You really have to stay tuned, see what's going on, and talk to your tax professionals. What's going on at the state level may be a little different. Some of the items that Brian talked about are either coupled or decoupled, depending on the situation. So, there's a lot to absorb here and a lot to discuss with your professionals. You want to talk about this one, Brian?
Sure. So this is another concept that was introduced. It's introduced as part of the Tax Cuts and Jobs Act. It's not a provision that we see affecting many of our dealers, but we do a lot of work in the real estate world as well. And so real estate development typically generates lots of losses, and for real estate professionals, they can deduct those losses. So we see it affecting some of our real estate professionals. Basically, what they did was they came up with this concept of an excess business loss, Section 461, and it basically, at the time, the number was $250,000 per individual, so $500,000 for joint, and it said if you've got more than $500,000 of business losses, so losses flowing through Schedule C, Schedule E, coming through your partnerships, coming through your S corps. Basically, business income doesn't include wages, doesn't include interest, dividends, any of that stuff. If the total losses on all that, when you combine them all together, is more than the threshold limit, so it's currently $626,000. So if it's more than $626,000, you're now in a position where you have what's considered an excess business loss, and that excess business loss gets converted to a net operating loss and is deductible in the following year. So you can't deduct it. So if you have $1 million loss in 2025, right? It's 626 that you can deduct. I wish the numbers were better. So 374,000, is that my excess business loss? Takes me a while.
Close enough, right?
Doing math in my head. It's not my strong suit. So $374,000 loss that you can't deduct in the current year carries forward. You get it in the next year, and it's an NOL. It can be deducted against anything: wages, interest, dividends, all that fun stuff. And so they did this. They also had a provision in there for it to expire after 2029. Notice that expiration date, because it's a revenue generator, is much later than the expiration dates on a lot of the ones where it was decreasing tax revenues. So they had talked about doing a couple different things here. One of the iterations of the bill had this excess business loss becoming permanent, and it no longer converting to an NOL. It was going to convert into this new excess business loss carry forward. So it would only be available to offset business income, just creating a whole new set of loss carry forwards, and more administrative work. I guess more work for the accountants, which I'm not necessarily opposed to. What this bill did was it extended it in its current form, so made it permanent. It's going to go on forever, and now it is. It will always be an NOL until they change the rule. It's back to you, right, Lou?
Yeah. So we talked about deductions before, itemized deductions. The old bill, the old jobs bill, eliminated miscellaneous itemized deductions through 2025. So if this bill didn't pass, we would have gone back to the old itemized deductions. There was a P's limit applied to the overall amount of itemized deductions. So what we've done is we've modified this. We've really strengthened the standard deduction. And in this case, it permanently eliminates the miscellaneous itemized deduction, except for an expansion of the deduction for educator expenses. So that remains in there. That was added. And it also creates a new formula that applies to taxpayers in the 37% bracket, effectively capping the benefit of the deduction at 35%. So there are some limitations in here for wealthier individuals, but the standard deduction is great. And if you have the higher state and local taxes, depending on what happens in the state of Colorado, you'll be able to deduct those at least at the federal level. We'll see what happens at the state level. The big one that we've all been waiting for is this lifetime estate exemption. Under the old TCJA, it was we were at 13.99 million for 2025, 7 million for that's per individual, and it was set to revert back to $7 million at the end of the year. That had a lot of folks concerned. The bill basically permanently increases the lifetime exemption to 15 million, obviously adjusted for inflation, starting in 2026. So it's $15 million per individual. That's great. We talk about being able to pass businesses from generation to generation. This certainly helps dealers, helps other businesses. I was going to say farmers and anybody who has family businesses. This is great.
I guess back to me, Lou.
Yeah, go ahead.
Yeah, I get to cover all the super exciting topics. So alternative minimum tax, AMT. This was something we used to see it a lot before the Tax Cuts and Jobs Act. So when you could deduct your state income taxes, the issue was state income taxes as a deduction was the most significant add back going from federal taxable income to alternative minimum taxable income. And so people were getting these big deductions, but then it was pushing it into an AMT situation. And so I guess they recognized that there was some level of this not being equitable. And it almost seemed like it was a middle class tax at the time. And so basically they did a bunch of things. They increased the exemption up to, I think it was $1 million or $100,000 or something. And then when you don't have the state tax act back, you weren't getting subject to AMT. So that was great. Tax Cuts and Jobs Act sort of fixed AMT and took it away from most people. We rarely see it. You know, there's situations, maybe when you've got large capital gains, one-off transactions, it might push you into an AMT situation just because of the different tax rates between regular tax and AMT. But overall, we don't see it anymore. But that was set to expire, so it was going to go back to the old regime. We probably would have seen a lot of people get kicked back into it, so they extended it. So they made the exemption permanent. And the only other thing they did, this is going to cause some people to get subject to it, is there's the AMT exemption, then there's a phase out on the exemption, right? And so you start out at this $109,000 exemption, and then that exemption amount starts to disappear as you hit higher income levels. And so now they didn't change the income threshold. What they changed was the phase out amount. So it's 25%, and now it's at 50%. So we're going to see some more people get hit with AMT. But again, once you get up to the higher income levels, the regular tax rates from a ordinary income perspective will be in excess of the AMT tax rate. So you're probably still not going to see it affect as many taxpayers. Lou, there is a question in the chat. I don't know if we want to just address it real quick.
Notice I didn't say anything about single or married filing jointly. These are individual exemptions. And if you are married, the first one would apply to who's deceased first, and then the next 15 million would apply to the second deceased. So it ultimately is worth $30 million. Overtime pay. This is one that's gotten a lot of commentary from us. As Brian said, the stuff that he's covered is kind of boring and technical. Everybody's interested in the overtime pay and the car loan deduction. So the overtime pay, it's an above the line deduction for individuals. Again, it expires, and again there are some limitations, some income limitations, but generally it's $12,500 for single, $25,000 for married filing jointly. It phases out for income over 150,000 or married filing jointly 300,000. You've got to phase out to ultimately it's completely gone by time a single taxpayer gets to 275 and a married filing jointly gets to $550,000. And again, the questions come in, what's overtime, what's not overtime. I guess it doesn't really matter. Whatever ends up on the box on the W-2 for overtime, however the IRS decides to set this up, that would be the amount that's deducted, and it applies to overtime compensation paid under Section 7 of the Fair Labor Standards Act of 1938. So again, each state has its own rules and regulations in terms of what's overtime, what qualifies for overtime, but ultimately whatever does qualify will be that amount that's deducted. And the car loan, same thing. This one expires in 2028. Individuals can deduct up to $10,000 of interest per year. And these are only for new car loans. This does not apply to pre-owned vehicles, just the new cars. Doesn't apply to any business or fleet vehicles, personal use only. And as everyone should know by now, it only applies to vehicles that where the final assembly occurred in the United States. And as I said, there's a limit. You can't, your AGI can't be more than $100,000, $200,000 for married filing jointly. And there's a phase out of $200 for each $1,000 above the AGI. The complete phase out again occurs at $150 for single, $250 for married filing jointly. Do we have any questions? No, I don't think so.
Just a reminder for you guys who overlap with the sales teams, much like the federal EV tax credits, because that deduction on auto loans does not apply equally to everybody. It is not something we are able to advertise. That would be an advertising violation under Title 44 of the state laws.
Very good. The charitable deductions changed a little bit. There were limitations under the old law. And again, this was expiring as of 2025. Under the new law, there's two sets of charitable deductions. There's a charitable deduction if you do claim that standard deduction that we talked about a few minutes ago, and that's up to $1,000, $2,000 for married filing jointly. And for individuals who do itemize, there's a permanent extension of a 60% limit, but charitable contributions are deductible only to the extent they exceed 0.5 of your adjusted gross income. The disallowed portion is carried forward only if there's a carryover in excess of the 60% limit. So again, talk to your tax professionals here, but you can have it. You have a deduction if you have a standard deduction. You get to deduct your charitable contributions, and you get the charitable contribution deduction if you itemize. So this is nice. You get that deduction under both sets. Now we're going to talk a little bit about some of the items that were eliminated. Again, this shouldn't be too foreign to anyone, but the clean vehicle credits are basically terminated as of September 30th, 2025. So any of the pre-owned credits, up to $4,000, that's eliminated. The new clean vehicle credit up to $7,500, that's eliminated. And the qualified commercial credit is eliminated as of September 30th, the 45W. So these credits are going away. It's, as we would all understand, it's probably a good time to contact your customers, let them know that if they're planning to buy a car, an EV, this is a good time to do it, that the clock's going to run out soon, and that we should be encouraging them to buy these EVs before the credit expires.
So that means no more transfer portal, right, Lou?
Yeah, I guess that's a blessing, but you know, it's good. It's good if people want to take advantage of purchasing an EV. Now's the time to do it. The other thing,
we will hop in with some further guidance as September 30th gets closer, but you can anticipate that much like the increase in the state lien fee for DMV, that this is going to be all deals submitted by September 30. So if you are making deals September 26, 27, 28, 29, and not submitting to the IRS portal the credit until 10/1, 10/2, even though they were contracted before the deadline, I would not be 100% confident that you're going to get that money back.
right. That's fabulous advice. As far as I know, Matt, you know, they may just cut it off at midnight, you know, on the 30th. So you may not even have access to the portal after that time. The other thing that everybody talks about are the charging stations, and that is also that those credits terminate as of June 30th, 2026. So to be allowed a credit, the property has to be installed and must be acquired before June 30, 2026. Then the 179D energy efficiency credit, that also expires after June 30th, 2026. So construction that begins after June 30, 2026 does not qualify for the credit. The clean electric production credit and the Section 48E clean electricity investment credit terminates for wind and solar facilities placed in service after December 31st, 2027. So again, you're installing any of this type of property, you need to work with your contractors to ensure that the property is installed, placed in service prior to December 31st, 2027. So with that, I think we can open it up for questions, Brian. Matt, you have anything else? And again, if you have questions offline, you're welcome to contact us at any point. Our contact information is on the screen right now. You can call us, email us. Things pop up. You may think of something later. So as these things arise, feel free to call us. With that, I think we have about 4 minutes left. If there's anything else. Margot?
And I think that we are all good, for me at least.
Okay, super. Well, thank you very much. We've appreciated this, and we hope that everybody is excited, if that's the right word, for these changes, and hopefully things will go well. Again, thanks a lot, Margot. Thanks, Matt. We'll talk to you soon.
We appreciate you guys' time, and we certainly have your information here if there are any follow-up questions and people would like to follow up with you directly by email.
Great. Thanks.
Thanks,
Take
everyone.
care.
Take care, guys.
Thank you.